We are living very exciting times. How ready the society is for serious digital disruption. Artificial intelligence is the supersonic level of data monetization. That the age of central bank digital currencies will bring a better life to humanity. After the 2008 crisis, what happened?
Today, our guest is CEO at Banking Reports and one of the top global thought leaders in FinTech, David Gyori. David, thank you for being here.
Thank you for having me.
We're going to talk today about banking innovations, current banking crisis, cybersecurity, progress of APIs, Millennials and Zoomers in finance, and global digital currency revolution. David, you travel a lot and you have a chance to interact with a vast number of financial systems. The banking system of what country seems the most progressive to you and why?
Banks in Singapore are highly innovative. Another one is Turkey. Turkish banks are following the path of inside-out innovations. And another one is Indonesia. Indonesia is a large country with the fourth largest population globally, and actually in the past 10 years they have gone through an amazing journey of meaningful financial inclusion. I also want to mention India. India was also an underbanked country, and then the government came up with a strong state-supported digital identity regime, as well as UPI, United Payments Interface, which is basically a QR code-based mobile wallet standard. In terms of cashless society, the Nordic countries within Europe, such as Sweden, Norway, Finland, they are very progressive, especially Sweden with Swish, which is a multi-bank-backed mobile wallet system. Africa is also surging. It's a very interesting situation globally because disruptive innovation, using technologies in a disruptive way, is in fact harder when we have more legacy. When we have a better banking system to begin with, it's harder to win a new cycle of disruption. This is the trap of disruption. The more successful you are in the prior paradigm, the harder it is to survive or even win the next paradigm. This is a paradox, basically. The stronger, the more advanced, the more developed a banking system is, there is more incentive for it to remain unchanged. So disruption has more way, radically new technologies have more opportunities to penetrate a market when the starting point is relatively less advanced. And Africa, as you have mentioned, is actually going through this disruptive exponential change at an accelerated pace. They are exponential. For example, besides M-Peso and different older forms of mobile money, such as M-Peso. Recently, I have been working with the market-leading bank in Ethiopia, and Ethiopia is going through amazing change. In Ethiopia, in May 2021, a new mobile wallet has been introduced. The name of this mobile wallet is Telebir. And basically 1.5 years down the road, or less than 2 years down the road, this mobile wallet in Ethiopia called Telebir has 28 million users. So it's amazing disruptive change, and the less developed the existing ecosystem is in a given country, the faster, the more radical it can change as time is going ahead. By the way, there is another important factor. The clients, how ready the society is for serious digital disruption. And the younger the population is, the more ready they are to embrace 100% digital, or digital first, or digitally native. And in these emerging economies, the population is often much younger. Median age in India is 28. Median age in Germany is 44. So there is half a generation of mismatch between these markets.
Let me remind you, my name is Denis Astapchenia. I'm head of financial technologies at Andersen IT company. Our research and development department works on the content for this channel and also collects the best practices of fintech software development. You can view the examples of such case studies on our website. The link is in the video description. If you need to go digital, cut operational costs, or automate business processes, we will offer the best possible solution for a business case. Contact us. I have a question about attitude of different generations to money, but I'm going to ask you that a bit later. And the second question is about your work. You are the CEO at Banking Reports, a London-based company that provides high-quality fintech courses for bankers around the world. What requests do your clients turn to you with most often? And what solutions and tasks do they usually want to resolve?
Right. So basically, I am providing top quality advisory services to banks and bankers all around the world. This advisory service can come in the form of a training program. It can come in the form of traditional advisory activities. And the core topic is successful digital transition, making your bank strategically as well as tactically and operationally ready for the next 20 years. And this is a $1 trillion opportunity as well as a $1 trillion challenge.
Research and Market Store expected the global fintech market to grow to 31.5 trillion by 2026. Then we have Silicon Valley, one of the largest American banks, which had invested in numerous technology startups, declared bankruptcy. Then Credit Suisse was bought out, and it's not over. Do you think this prediction is still valid and will come true? How can current banking crisis affect these predictions?
Right. So basically, one of the key lessons is that digital excellence, digital transition is a great thing, but it has not eliminated traditional financial risks. Endemic financial risks related to credit risks, related to asset liability management, related to balance sheet risks, related to liquidity, related to capital, have always been with us in the past 5,000 years, and they will always remain with us. Now, this is one thing. Financial technology startups, technology giants, e-money institutions, as well as licensed banks, well-established credit institutions, smaller, medium-sized, or large, globally systemically important ones, such as Credit Suisse. They are all subject to the good old asset liability balance sheet leverage related lending related liquidity related capital related trust related risks which have been with us again for 5,000 years. Now, since the 2008 financial crisis, financial technology, the fintech ecosystem with startups, with technology savvy, small, relatively small, nimble, flexible, digitally native, creative, fast-moving, open-minded, disruptive companies has been evolving on one side, while on the other side, 20,000 licensed banks with 200 trillion US dollars of aggregate total assets globally have been trying their best to go through in-depth digital transition. Now, in the next 10-15 years, these two ecosystems will evolve more near to each other. They will get more near each other. They will almost melt together through strategic partnership, mergers, acquisitions, takeovers, all sorts of forms of cooperation and competition. So these two relatively distinct ecosystems in the next 10-15 years will almost step by step incrementally melt together, and we will end up having very efficient, digitally excellent banks with traditional background, as well as digitally excellent and digitally native banks or quasi banks with fintech background. So the two ecosystems will converge, so to speak, step by step. The first signs are already on the wall, but much more merger, acquisition, takeover, strategic partnership, as well as in-depth cooperation is in the pipeline.
So let's talk about millennials and zoomers in finance. The whole world is now adapting to a new era of technology, the digital era. You say that this is not an easy task because the era is driven by a new segment of customers, millennials and zoomers. So how does their financial behavior differ from that of the previous generations of consumers? And what are the advantages of zoomers compared to millennials?
Right. So this is a very important and a very beautiful topic, because the core clientele of traditional banks has always been the baby boomer generation, the great generation after the Second World War. And now, step by step, millennials and members of Generation Z are becoming the most profitable segment in terms of traditional banking. And this requires very serious adjustments from traditional banks and bankers. So, for example, millennials and Generation Z are 100% preferring digital solutions. There is an asymmetry. Millennials and members of the Generation Z demographic group, they are not interested in learning about good old physical solutions. Baby boomers, often the parents of millennials and Generation Z, they are trying to embrace digital with more or less success. However, millennials and Generation Z, they are not trying to embrace traditional physical channels. Their sole preference is digital. They also want everything immediately. That's why we also call them the instant generation. What used to be 5 minutes for a baby boomer to fill in a product application form, to wait for something, is now 5 seconds for a millennial or a Generation Z, even younger person. Now, this is a fundamental difference. So, real time, instant, one click, immediate solutions and applications and ways and channels and communication and feedback is needed. Millennials and Generation Z, they are also believing in something called algocracy. The word algocracy comes from the expression democracy and algorithms combined. That's what we call algocracy, the power of algorithms. They often have equal or stronger trust in algorithmic advice than in human advice. This used to be the diagonal opposite with baby boomers. They primarily tend to trust human advice. Millennials, Generation Z, they believe the news Facebook is pushing, the pictures Instagram is calling their attention to, the recommendations Netflix is giving to them, the portfolios a robo-advisory solution is choosing for them and automatically allocating their funds into is better than human advice. And this is a paradigmatic shift. Artificial intelligence, black box artificial intelligence, machine learning propelled algorithms. This young generation statistically prefers this sort of advice, recommendation, analysis, insight, wisdom, knowledge, guidance. This is very, very important from a banking point of view.
It's an amazingly interesting topic, and it feels you can probably talk enough for a book. And I'm going to ask you one more additional question. So millennials use credit cards for their day-to-day expenses. Some of their credit card debts may be related to decisions they made when they were much younger than they are today. So why do millennials have so many debts? And where did the habit of living on credit come from?
Right. So basically, first, let's define these generations. Millennials are the people who turned adults in the new millennium. Millennials are the people who turned 18 years old in the year 2000. Therefore, millennials are the people who were born in 1982 or later. Therefore, millennials are the people who are now, in 2023, 41 years old or younger. However, every generation is 15 years long in terms of marketing. So millennials were born between 1982 and 1996. Between 1997 and 2012, Generation Z was born. So these are the precise generational definitions. 1982 to 1996, millennials. 1997 to 2012, Generation Z. Now, your question was about debt and millennials. So basically, millennials love combination of savings and credit. They have learned from their parents, the baby boomers, and the baby boomers were statistically seriously affected by the 2008 financial crisis. They were typically over-leveraged. They had too much debt, mortgages, car loans, credit card debt, and their children, the millennials, are statistically much more careful when it comes to taking credit, getting loans, using active products where the bank or the financial technology startup is giving money actively to these young people. They usually like to combine saving and spending. For example, micro investments, where you buy something for $1.79 or British pounds and it's rounded up to $2 or 2 British pounds, and the remainder 0.21 or 22 goes into automatic investment savings. These are better products for the young generations. They are very careful when it comes to credit compared to their parents. Now, the supply side of credit has partially been less careful. Peer-to-peer lending, crowdfunding, buy now, pay later recently. These sort of bubbles have all been built on the false premise of technology reducing credit risks. Let me tell you, technology across the board is not reducing endemic credit risks. Credit risks which have been with us ever since grain loans in Assyria. Credit risks which have been with us for 5,000 years. Yes, technology can provide us better data, more up-to-date data, more diverse data, like Sesame Credit in China, run by Alibaba Group, sucking in and automatically analyzing through a big data AI model more than 1 million new data points per user per day, calculating and recalculating minute by minute their Sesame credit scores. This is very, very good, but credit risks are still there. Sesame credit, big data credit scoring, social media credit scoring, social credit, crowdfunding, peer-to-peer lending, buy now, pay later, artificial intelligence in risk assessment. All of these can give you a slight competitive advantage when you play it right. But the vast majority of financially determined credit risks remain there. There is no magic algorithm in lending, and there will probably never be a magic algorithm in lending. Credit lending will always remain risky. By the way, this is one of the beauties of good banking. When you understand those risks, when you know how much you can mitigate, how much you cannot, then you can build safe financial services.
According to a 2022 McKinsey report, total global financial market capitalization reached its peak in 2021, amounting to $16 trillion, and then dropped to $14.5 trillion by May 2022. One half of this estimation belongs to traditional banking facilities, while professionals and fintech make up the other half, compared to 30% 5 years ago. So does this mean that the trend is set and fintech companies are confidently winning a piece of pie from the banks?
So basically, financial technology is a fraction of financial services all in all. The vast majority of the total assets of financial services globally is owned by the old guard, by the traditional financial services providers. However, as it usually happens with disruption and disruptive technologies and market disruption as a process, over time, this relative market size is getting rebalanced. Slowly, the newcomers are growing while the traditional financial services ecosystem is basically stagnating in terms of total size. And in fact, the good players, the viable players, the skillful players, the players based on and built on good premises are growing rather exponentially. Exponential growth in the first 3, 5, 6, 7, 8, 9, 10 years can be 3, 4, 5, 7, 8, 9, 10 years can be slower than exponential growth. However, these newcomers are growing exponentially while the traditional ecosystem is stagnating. So this rebalancing is happening all in all. However, it's a slow process. These are 7-year, 15-year, 30-year cycles. It's a little bit like cars and horses. That cycle of disruption happened in the course of 50 years. So basically, this rebalancing is happening, it's serious, but the end game will not be the new ones eating the dinner of the traditional players, but it will be some sort of coexistence. The traditional players becoming digitally excellent, the digitally native players becoming financially excellent, and excellent in terms of compliance and actually owning a banking license, and the market as a whole will grow. More people will be meaningfully financially included. And every good player will be a winner. It will not be a zero-sum game. It will be a competition and cooperation at the same time. There will not be one winner. There will be multiple winners. For example, the greatest winners are the customers themselves. Every innovation, every new way of competition, every competitive action between the old and the new players will be beneficial to the customers.
So many experts claimed that in the long run, banks will need to shift from traditional business model to more forward-thinking platforms that potentially separate business units, such as day-to-day banking and complex finance or advisory services. Are the expansion of banking services and the creation of an ecosystem around the bank really salvation in your opinion? And what should banks without the resources to create their own ecosystem do?
Right. So the name of the game is data. The 21st century, our century, the current century, is the century of data. Data is basically the new oil. Data is the new key input resource of the economy. Data is like oxygen. We are breathing data, as Chris Skinner recently stated in a great speech. And data as the key input resource of the 21st century economy is a very different resource compared to the key input resources of the 20th century industrial capitalism. Oil and gas are linear, additive resources. The value as well as the cost of 2 barrels of oil is the equivalent of 2 times 1 barrel. Data is very different. Data is a synergetic resource. Data is an exponential resource. Data is a multiplicative resource. Putting data and data together, you can create additional value, positive externalities. You can create synergy. Therefore, in the century of data, you can create additional value by creating an ecosystem, a system, an architecture of data synergy. Different sources of data put together onto one platform. This can create significant additional value compared to data silos. And actually, these different sources of data can be connected and linked to one central platform through APIs, application programming interfaces. Application programming interfaces are the 21st century superhighways of data. These are the new gas pipelines. These are the new oil pipelines. APIs, application programming interfaces, and the new oil, the new gas flowing in these pipelines is data itself. Now, physical, traditional, industrial capitalism, linear, additive resources such as oil and gas defined an economy which Michael Porter beautifully represented visually in terms of competitors versus business partners. However, the data economy is about both. Your competitor can be a meaningful business partner. Your meaningful business partner can be, and maybe even should be, your competitor at the same time. This is why now we talk about co-opetition, competition and cooperation with the same entities at the same time. Because in this new data economy, when you cooperate with your competitor while keeping strong competition up and alive, that's a legal requirement as well, and that is our nature. We want to compete. So keeping competition up, you also cooperate. That creates bigger and better dinner for everyone. And then we can share that dinner. However, cooperation, building ecosystems internally or half internally or externally or half externally has an additional benefit, has a positive margin, has an added value. And this creates the case for data ecosystems. Now, technology giants such as Google, Apple, Facebook, Amazon, Baidu, Alibaba, Tencent, they are natural grandmasters of creating these data ecosystems. Their DNA, their original value creation engine has been data ever since they have been created. For traditional banks, 20th century institutions, large incumbent, market-leading, successful banks, data is a much harder resource to handle, and you can only build data ecosystems, you can only connect externally or internally all sorts of data resources with each other if your data architecture is in good shape, is in order, is state of the art. So this is a great challenge. Get your data right. Saying it is 1,000,000 times easier than doing it and achieving it. But this is a precondition of building successful ecosystems, successful data ecosystems. By the way, what will be the next level after building these data ecosystems? Artificial intelligence. Artificial intelligence is the supersonic level of data monetization.
Large-scale leaks of user data have been the scourge of recent years, which have affected all areas. And digital banks still cause distrust and fear among customers in terms of cybersecurity. Are classic banks really more secure? And what security options can digital banks provide to customers?
Data privacy is a very, very interesting question because there are two major types of answers to the challenge of data privacy. The customer owns the data, or the services provider owns the data. In the European Union, especially under GDPR, primarily the customer owns the data. In Southeast Asia, for example, China, the paradigm is a little bit different. Primarily, the services providers own the data. Now, interestingly enough, these two very different paradigms tend to lead to the same conclusion. What is this same conclusion? Data monetization, data growing into an asset class, data growing into a commodity of its own. Why? Because when the customer owns the data, different services providers can implicitly or explicitly buy this data from the customer, use this data, for example, aggregate it, analyze it, slice it, dice it, and resell it, explicitly or implicitly. Now, in the Southeast Asian paradigm, the services providers own the data. In return, they must provide highly valuable services to the users. For example, Alipay and WeChat Pay have de facto marginally negative interchange rates. The merchants accepting Alipay and WeChat Pay are getting paid for every single payment they are accepting marginally. Why? Because of the value of data. So, the Western model, Europe to a great extent, United States to a lesser extent, where the customer owns the data, and Eastern model, where the services provider owns the data, are leading to the same conclusion: data monetization, data as an asset class. Now, this is data privacy. Cybersecurity is a much harder issue because cybersecurity is a new risk dimension, a new category of risks basically emerging everywhere in our life. And probably we are having a big, sizable and fast-growing cybersecurity debt, cybersecurity overhang. So, banks are spending more and more on cybersecurity, and that's great. However, cybersecurity risks, in terms of their total value at risk, in terms of our total exposure, are probably growing exponentially. So, what I am expecting is that more and more of these cybersecurity risks will unfortunately materialize. And in fact, several experts are saying that it is a when and not an if that a major cyber 9/11 will occur. An analogy of the September 11 events in the world of cybersecurity. And that is very dangerous because now we are in a state globally where physical risks and digital risks are intertwined. So cybersecurity is a constantly, monotonously growing, unsolved issue, a growing exposure in fintech, in banking, and in every other industry. And what I am afraid of is that some of these unhedged risks will materialize in the coming years. Banks are intergalactically better in terms of cybersecurity than fintechs. Typically, across the board, banks are relatively risk-averse creatures in general, and they have been spending on cybersecurity in the past 20 years increasingly heavily. Still, it's not enough. There are general, intertwined, multiplicative risks across the society. By the way, step number one would be to create very much secure, state-supported digital identity regimes to be able to objectively identify who is who, what is what in a compliant online environment. By the way, there are three types of entities in this sense. In terms of modern, strong digital identity, individuals, legal entities, and machines. In the world of Internet of Things, we have to have a strong state-supported identity for every single machine. We have to be able to identify that it was the fridge telling our air conditioner to slow down, which resulted in someone catching cold, which triggered an insurance event, which led to paying premiums, and so on. So these lines of events have to be able to be tracked back, and for that we need strong state-supported digital identities. By the way, compliant onboarding into banking, into e-money institutions, into mobile wallets, into any sort of financial services begins with a strong state-supported digital identity, which is mostly currently not present.
Looks like there is no chance we create a 100% reliable system that excludes access to personal data ever, but let's see. And the next topic is open banking and progress of APIs. January 13, 2023 marks 5 years since the Competition and Market Authority first introduced open banking. And currently there are over 1 billion API calls in the UK every month. So 2023 can become a tipping point for open banking payments in the UK and the US, as new payment services using open banking APIs are the top priority for IT product investment. So how do you see the progress of APIs and how will open banking evolve?
Right. So in this sense, this is a very good question. And in this sense, the most important thing is that PSD3, Payments Services Directive 3, is already in the pipeline. The first draft texts of PSD3 will come up within a couple of months in June, July, August, September, or October 2023. This first draft text of PSD3 will basically readjust PSD2 regulations. PSD2 regulations, the basis of open banking as we know it, at least across the European Economic Area. And this is very, very exciting. How current EU open banking regulations will be readjusted. For example, In the United Kingdom, as you very well stated, open banking has been actively in force since the 1st of January 2018. You were very precise. Due to an IT glitch, the system started to operate practically on the 13th of January 2018, but on paper it's in force since the 1st of January 2018. Now, in the UK, after approximately 5 years, we are seeing nearly 300 active third parties under open banking. AISPs, Account Innovation Services Providers, PISPs, Payments Initiation Services Providers, and other players in the ecosystem. For example, ASPSPs, Account Servicing Payment Services Providers, which are de facto payments institutions, which are de facto credit institutions, i.e. banks, building societies, and some other type of entities. And this ecosystem in the UK is so vibrant and so creative and so exciting because in the United Kingdom, application programming interface standards, API standards, have been in force from day one. So one of the big questions of PSD3 will be if in the rest of the European Economic Area, API standards, standardized application programming interfaces will be set or not by this new regulatory turn, this new regulatory wave, this new regulatory paradigm. There are many, many other questions. For example, PSD3 will probably also partially re-regulate the relative relationship between credit institutions and e-money institutions, EMIs, as well as the relative relationship between EMIs, e-money institutions, and PIs, payments institutions, and many, many more questions. So in terms of open banking, what is very important is to learn from the UK example, and one of the lessons is that in order to create a successful, vivid, lively, active, colorful, creative, inspiring, market structure transforming open banking ecosystem, we do need API standards.
Over the past couple of years, we have witnessed a global digital currency revolution. Which one is more promising in your opinion? Stablecoins, cryptocurrency, or CBDC? And what do you think can prevent digital currency from becoming dominant?
Right. So this is a very, very important question because it's full of misunderstandings. And these are trillion-dollar misunderstandings. So decentralized, private, digital, cryptocurrencies as they are now will prove to be non-viable. They are not compliant. They cannot provide nominal price stability by design. They lack interest rate content as well as intrinsic value at the same time. They are basically breaking the control of sovereign states over the monetary supply in an economy, which is a theoretic control. It doesn't have to be actively there, but it has to be an available option. If a state wants to impose objective control on the monetary supply in its own economy, it must be able to do it. And Bitcoin, Ethereum, Dogecoin, Litecoin, and the 2,000 other private cryptocurrencies are breaking this monopoly of monetary supply. Now, still, this world, this universe, this galaxy of cryptocurrencies has been extremely creative, extremely colorful, extremely inspiring, extremely innovative. Honestly, the construction of Bitcoin is pure genius, absolutely genius. So, what will happen? The same thing will happen as it has happened all over monetary history. Innovations coming from the private sphere, innovations originating from the private players, and sooner or later, usually sooner, ending up in the hands of sovereigns, ending up in the hands of states, ending up in the hands of modern, relatively independent central banks. What will be the reincarnation of decentralized cryptocurrencies into the hands of modern central banks? Well, the answer is 4 letters. CBDCs. Central bank digital currencies. Now, central bank digital currencies are not only going to happen because of this pattern in monetary history, central bank digital currencies will also happen because cash across different economies, from China through India to the United Kingdom, Sweden, and the Netherlands, is de facto going out of circulation. And if cash goes out of circulation, then there is no direct liability of central banks in the economy, which is a monetary tool, which is a very important part of narrow money, M0, monetary supply. Therefore, a digital reimagination, a digital manifestation, a digital reincarnation, a digital version, a digital analogy of cash is necessary. A digital version of cash has to be present, which the central bank can issue or filter out from the economy, and which is a direct liability of the central bank. And the digital version of cash is CBDC. In 10 years, central banks will carefully, slowly, in a manner of running pilot projects, in a manner of experimentation, roll out mobile wallets. You hear me well. Central banks will roll out mobile wallets. And into these mobile wallets, they will provide the opportunity for you to exchange cash into central bank mobile wallet liquidity, money, value in your central bank mobile wallet in return for cash. And people will be able to channel money between their bank accounts, between their private mobile wallets, as well as the central bank mobile wallet. And the most important consequence of central bank digital currencies, the most important consequence of a de facto cashless society will be the long-awaited, historically awaited symmetry in interest rate policy as a transmissive channel of monetary policy. Ever since central banks, ever since modern central banks are using interest rate policies, and we see how this is playing out globally, currently in front of our eyes. So ever since modern central banks are using interest rate policy, it has been a one-way street. It has been doomed to be fatally asymmetric. Why and how? In terms of positive interest rates. Central banks could hike, could raise the rates as long as they wanted. However, in terms of nominally negative interest rates, the channel has always been limited. Why? Because historically, if interest rates go under negative 75 basis points, i.e. minus 0.75% per year, then companies and individuals start to withdraw bank account money and keep it in cash, because they don't want to lose more than 75 basis points per year, which is the approximate wholesale cost of cash logistics, safe storage and logistics of cash. Therefore, central banks historically have been paralyzed, limited in terms of negative interest rates. After the 2008 crisis, what happened? Central banks should have lowered interest rates into serious negative territories, but they couldn't. They couldn't because the Swiss National Bank, they couldn't because the Bank of Japan, they couldn't because the Federal Reserve, they couldn't because the European Central Bank, they couldn't because the Bank of England were all limited by the theoretic barrier of negative interest rates. Therefore, they had to find a monetary tool which substitutes seriously negative interest rates in terms of its expansion, in terms of its stimulation, in terms of its stimulus to the economy. Interest rate policy being a one-way street, interest rate policy being free in terms of positive interest rates, unlimited, theoretically uncapped, however, very much squeezed into 0 to minus 75 basis points in terms of negative rates, led to alternative solutions of monetary stimulation, such as quantitative easing. However, quantitative easing applied after the 2008 crisis necessarily leads to serious levels of inflation. These serious levels of inflation trigger a tightening cycle in monetary policy, i.e. higher and higher and higher nominal positive interest rates. And we see that this tightening cycle has extreme costs. We see how banks are going down in front of our eyes because of this interest rate volatility, displaying in front of our eyes. Therefore, cashless society, which from a traditional monetary aspect is propelled by central bank digital currencies, the digital reincarnation of cash. So cashless societies are the answers to fixing this long-lasting impossibility, this long-lasting historic shortcoming, this historic paralysis of monetary policy. And this is beautiful. This means that the age of central bank digital currencies will bring a better life to humanity. The age of central bank digital currencies will provide a better moderation of economic cycles. The age of central bank digital currencies will make it possible for fiscal and monetary policies to better coordinate and cooperate. The age of central bank digital currencies will reduce the amplitude of macroeconomic cycles, thereby providing a more smooth, socially more bearable, socially more sensitive, socially more manageable, more predictable, easier to plan type of macro-monetary, macroeconomic, social, socio-demographic environment. And this is a historic achievement. We can say goodbye to second-class and third-class substitutes to real negative interest rates, because the lack of cash and CBDC as a cash substitute in the economy will open up the negative side of the interest rate policy and interest rate channel. We are living very exciting times. We see banks getting into trouble. We see banks screwing up again and again. But I have good news. In the background, in fact, in the depth of these processes, there is progress.
David, thank you very much for talking to Andersen.
I thank you. Thank you.